integrate the Fenix Newhall business and maintain our operations with strong focus. And now we need to continue that in what is a much better price environment. So looking forward to building cash during the second half and also continuing to look for new opportunities for Fenix.
Hello everyone and welcome to today's webinar with Fenix Resources. I'm Dannika Warburton. I do the investor relations for Fenix and I'm joined today by Chairman John Welborn, who's going to run us through the half-yearly results. If you would like to ask a question, you can do so at any time by typing it into the Q&A feature down the bottom of your screen, and we'll get to those at the end after John provides a summary. So I will now hand over to you, John, to update investors.
Thanks a lot, Dannika, and welcome everyone to this webinar for our half-year financial results. As you know, this is for the 6 months ending 31 December 2022, which was a challenging period for anyone in the iron ore game, given a significant drop in the iron ore price. And it was a good period for Fenix in operations, and we're very happy to announce an $11 million net profit after tax. Summarising some of the key outputs of the half year, obviously a lot of these numbers were already reported in our quarterly activities reports, where we try and give a lot of detail about the business. So it shouldn't have been a surprise that we shipped 11 ships during the 6-month period. That was a total of just under 660,000 wet metric tonnes of iron ore, demonstrating again that Fenix is operating very consistently at our 1.3 million tonne per annum run rate. The average price we received for those iron ore on a dry metric tonne basis was 112 Australian dollars FOB Geraldton, and so that's equivalent to $75 US. And given the prevailing shipping rates out of our control, that was equivalent to receiving $100 US per dry metric tonne on a CFR basis, which is obviously the iron ore price that people would look at as a reference price or is reported in the news. That drove a total, along with our hedging revenue, which I'll talk about, that drove a total revenue for the business for the 6 months of 85 million Australian dollars. The highlight of the 6-month period was the reduction in our C1 cash costs, 10% down to 81.25 Australian dollars per dry metric per wet metric tonne. And I'll talk a little bit about our C1 cash costs and how that was achieved. Gross profit of 8.3 million resulted, after accounting adjustments, in a net profit after tax of 10.9 million. And that allowed us to maintain a strong balance sheet. We've got just under $50 million in cash as at 31 December, and that was after paying a healthy 5.25 cent dividend fully franked during the period, which was a total of 28 million, and caught up our tax payments with $22 million. During the period, we achieved a milestone of 2 million dry metric tonnes of shipments in total, and that's a great achievement, and we're adding to those tonnes every day. We covered in the summary announcement a little bit of detail around the C1 cash costs, but also obviously the decision not to announce an interim dividend, and that's driven by a decision for the board that we're very clear we're committed to our dividend policy of paying between 50 and 80% of after-tax profits as a fully franked dividend, obviously subject to the availability of franking credits. We've just gone through a very volatile 6-month period, and obviously we're confident in a strong second half based on prevailing spot prices. But what we'd like to do is pay a consistent, sustainable and clear dividend based on that policy. And it is designed to be driven by the final full year numbers, which allows us to make a clear decision. And also based on obviously the circumstances of the company at the time and any growth agenda that we're requiring to fund. So that was the summary of the 6-month period. I'm interested in some of the questions that we've got, Dannika, but I would like to talk a little bit about some of the key takeaways from the half-year report, and also the discussions I've had with shareholders. I think it's really relevant when we talk about our performance that we have focused in the announcement that its cost discipline drives $11 million net profit after tax. And there's two parts of that cost discipline. It's our operating and management cost discipline, but it's also our strategic cost discipline. And I think the half year really demonstrates both. The strategic cost discipline comes through in our hedging policy. And anyone who looks closely at the accounts will notice that the hedging was a key part of maintaining our profitability during the 6-month period. And the other strategic cost initiative was the Fenix Newhall transaction, which was potentially even more important in maintaining profit during the period. And I'm very happy to talk about that in detail. But before I do, I just wanted to talk about the iron ore industry that we're operating in. We're a small scale player. We've got a unique advantage in that we control our infrastructure assets, being our haulage operation and our port operation. But I note that among our peers, if you look at the first half performance, we're in an industry that is suffering unprecedented inflationary pressures. And that's coming at miners across the board. People who look at the industry may note that FMG C1 cash costs compared to the prior period in their half-year accounts are up 23%. Rio Tinto's are up 21%, and BHP performed better there, but their C1 cash costs are up 11%. Now, in an environment where there is high single-digit inflation and unprecedented cost inflation across the mining industry, which Fenix is not immune from, I'm very pleased and think it's quite a remarkable performance across our business that we've reduced our C1 cash costs by 10%. And the reason we've been able to do that is because of the acquisition of the Fenix Newhall business. We've indicated and we confirm that acquisition is resulting in more than $10 a tonne cost saving. It's also driving a much greater control on the strategic cost drivers of our business. So when people look at the numbers and try and back out what Fenix Newhall has done for the business, it's important to understand that, for example, fuel costs January to January are up somewhere in the order of 40 cents year on year. Now, every time we see a 10-cent rise in the fuel price, that results in a cost of Fenix of about $1 a tonne. It's a simple metric. So, the inflationary pressures we're seeing in every other miner impacted parts of our business. We probably had between $2 and $3 a tonne of extra costs in this half from fuel. And we've also had wage inflation and rise and fall impacts across our contracting business on the mine side. Now, we've more than offset that with the savings we've made by consolidating the Fenix Newhall business. This is a state-of-the-art haulage business. We now own 26 complete prime mover and quad trailer sets. Those trailers have a life of between 15 and 20 years at a minimum. They're purpose-built here in Western Australia. They've been designed. They take 140 tonnes in 4 trailer systems. It's unique. And along with the prime mover, they're 65 metres long and very efficient. The prime movers, we have an ongoing replacement model, and we do 800,000 to 1 million kilometres in those trucks, and then they're replaced. And we've been taking advantage of a very strong second-hand market where we've actually been able to generate greater than the book value of those trucks. So like a hire car business, if you're ever hiring a car, you're always getting in a fairly new model. So the drivers at Fenix Newhall are getting in new state-of-the-art trucks, and our fleet today is in a very similar condition to our fleet a year ago, and our fleet in a year's time and 2 years' time and 3 years' time, due to that unique replacement model that we run, will maintain a state-of-the-art, very efficient, highly effective haulage network. It's a robust business, it's a profit generator, and importantly, it's driven cost savings we can see in the quarterly and in this half year but it's also potentially a growth engine for the business, because we're looking to expand our mining activities, but we're also looking to expand our logistics activities. And the Fenix New Haul business absolutely gives us the opportunity to look at third-party haulage on a profitable basis as we build and expand the business. I know there are a lot of questions about that. A lot of questions about the dividend, which I hope are very clear from our repeated statements about our commitment to the dividend policy, but also the need to base that dividend on the full year numbers, and allows the team to be really motivated around generating strong profits in the second half, so that we can maintain our dividend levels. And that'll obviously be based on the profit we can generate across the business. Very pleasing that we've got a very strong hedge book for the entire second half of the year. We've got 50,000 tonnes locked in at $172 a tonne every month to June. And we're also obviously enjoying high spot prices, which is great. One thing in the half year I do want to call out is our decision to provide a small allocation of shares to 112 people across our business, and issued roughly 450,000 shares, as well as some key performance rights and retention rights to key members of management who've been with Fenix since its inception, largely. The team are operating really well. We've had no significant turnover. We run a very small team at the mine, led by Chris Tuckwell, our general manager. In our haulage business, led by Craig Mitchell and Jamie South, and in our port team, headed by our commercial manager, Adrian Third, and also strongly supported by Jamie Jones. And those teams are working really hard and very effectively. And I think it's great that they're proud of their work, and also the board are very keen for all of our key employees across the business to feel like owners of the business and actually be owners of the business, enjoying in shareholders in that participation. So it was a strong year, difficult time, but we're looking towards a strong second half.
Thank you, John. Yes, there's been lots of questions come through. I've attempted to summarise them into key themes. A couple that have just come through on the Q&A, and just to reiterate, if you'd like to ask a question, you can do so by typing it into the function, Q&A function down the bottom of the screen. On the hedging that you were just running through, how much did it contribute to Fenix's overall revenue protection?
It obviously locks in a significantly positive margin on a little bit less than half of our production. And we've maintained a similar level of hedging month on month since we established that program. During this period, we completed the swap programs on what were very high hedges at 230 Australian dollars a tonne. We've now locked in, subject to the market condition, hedges at 170. And so we had a very strong hedging performance. It roughly provided about $15 million of revenue out of our $85 million of revenue, and that's purely on the margin we generated from the swap contracts between the prevailing spot price and the average monthly price that we've hedged at $172. And so that represents the very steep dip in prices halfway during the period, but also is an excellent demonstration of why we're hedging. It means that when prices do go low, that roughly a bit less than half of our production generates a good margin, and that's a policy we're going to continue to do. Obviously, we need to be opportunistic around locking in those hedges at a forward, and the curve drops off the further you go out. So generally we try and keep our hedges somewhere between 4 and 8 months out in front. And so in February we're hedged out to June, but we're looking to lock in some hedging out to December as soon as we can, based on market conditions.
Okay, perfect. Thank you for that. There's been a few questions around exploration, and what you're doing to extend the mine life at Iron Ridge. Could you please address that, John? Sure.
So we're obviously very focused on growth, and we've spoken about it a lot. The incremental growth starts with our existing ore body. So something we're looking to do during 2023 is engage some exploration geologists and look at what extension potential there is to the existing Iron Ridge ore body. There is a logical time to do that based on our mine plan, and so that's why we've delayed some of that work, looking at can we extend laterally and within the available heritage envelope of Iron Ridge. There is some geological confidence that we may be able to extend the existing ore body, which is obviously a first prize. The second part of our exploration program is to look at the ferrous iron ore land that we've acquired all around us, quite a significant package, and we've done that review during the period that we're reporting on. At this stage, we're evaluating whether or not we're going to drill some of those targets. The acquisition of that ground had a number of aspects. Iron Ridge, anyone who looks at a map will realise it's a very small footprint, and even an expansion of the existing Iron Ridge mine will require additional surface area for Fenix for the waste dumps and operational requirements. And so part of the deal on the ferrous ground was that we have expanded significantly our available footprint. It also gives us a much larger access point into other Midwest iron ore projects. And that's also our focus. So as well as expanding our Iron Ridge project, as well as the exploration potential in the ground that we control, we're also evaluating, and have been for some time, looking at opportunities of known iron ore deposits within the region that are interested in collaboration and or available for acquisition, where we can use our existing infrastructure. Now, obviously, I'd love to report that we achieved an outcome in relation to the expansion of our reserves, the expansion of our resources, exploration success, and or collaboration, cooperation, joint venture and acquisition. And obviously we'll do so when we've locked in any of those details. And so shareholders should be confident that anything material we'll disclose whenever we can, and we're working very hard on it. The business is obviously operating well. We've got continuity going forward into 2027 and perhaps beyond, and we're very focused on extending that mine life, and now's the time to work on that.
I know that you're, we were touching on sort of a backward-looking summary of the half year, but looking forward, is there anything that you can tell us about what's happening behind the scenes on the growth front?
Yeah, I think we've got a wonderful opportunity. So we've been very consistent about the sort of the focus that we have with growth. It starts on our existing business, and I've just described our iron ore business, but we're also now a significant logistics function with both our port assets as well as our haulage operation. And so the Midwest is an area with a number of existing operations, but also significant development operations in critical industries, and we're obviously looking at iron ore potential, and we'd like to not only extend our mine life but increase our production rate. And we're doing a lot of work about the bottlenecks in our business, both in haulage and port, that would then unlock the capacity to mine at a greater rate if and when we have those available resources. And we're also evaluating the opportunity to generate profit for shareholders based on third-party logistics provision, because one of the things we're proving in our existing business is we're really good at it.
Yeah, there's sort of two questions that tie into what you just said. You mentioned that Fenix, Newhaul, that transaction, and that business is a growth engine for the company. Is there, David has asked, did the haulage buyout completion costs come from this 6-month report? And did it affect the numbers at all?
Well, Fenix Newhaul affected the numbers in a number of ways, and there's some of the questions that have come through directly to the company since we published the report around the accounting treatment, and they're explained in the notes to the accounts, but any clarification of that, either myself or Stuart Osmeyer, our Chief Financial Officer, are very happy to respond to. In relation to the cost saving, yes, they're absolutely critical. I ran through the reality around the inflationary pressures. So just to demonstrate that a little bit clearer, and to respond to the question you're asking, Dannika, let's just imagine that the prior period, Fenix's C1 cash cost was $90 a tonne, and we've said that we reduced it by 10% to 81 odd in this half. But if, like our iron ore peers, we'd had a 20% C1 cash cost increase, based on the inflationary pressures that are absolutely evident, and fuel price rises and other impacts. Well, our C1 cash costs would have gone from $90 to close to $110. Now, if you back that out to an FOB number in Geraldton, we would have been losing money on every tonne we ship. We made money on every tonne we ship outside of hedging, only because of the significant cost reduction we achieved from Fenix Newhaul. So just to be clear, we suffered cost increases, at our mine fleet, in our wages, in our fuel costs. They were more than offset by the savings we generated from Fenix Newhaul by reducing the profit component of 50% of our 50% joint venture partner, and being able to take direct control and drive the business towards the outcomes that we're looking for, which is to maintain profitability for our shareholders. So anyone who doesn't realise that needs to look at the accounts and needs to understand that we are alone in the business, being an iron ore provider in the Midwest, who's managed to save costs in a period of unprecedented cost inflation.
Mm-hmm. And given the success of that joint venture, which obviously Fenix now owns 100% of the Fenix Newhaul business, would you consider diversifying into other commodities, maybe via a joint venture, which is what David has asked? He says there's some potentially great opportunities for growth in other commodities in the region, and you've got some substantial cash at bank. Is that something you would consider, or are you purely iron ore focused?
Look, we're very focused. This business is running well, and in the first half it demonstrates that we're disciplined in running it. But yes, the board are also very focused on, and if you think about the board, you've got Gary Plowright, who's one of the original vendors of the project, and one of the key architects of the success of Fenix. You've got Craig Mitchell on the board joining me, who's the founder of Fenix Newhaul and the other side of our very successful joint venture, and a renowned entrepreneur. And we've got a great team, and we're looking at all sorts of opportunities in the Midwest around our infrastructure and our mining credentials, and anywhere that we can use our skills to generate the sort of profits we've been generating for our shareholders, we'll look at. Obviously, the diversification of commodity could be a positive if it fits within the scope of our business and its synergies. It has strong synergies with what we're doing. So haulage, port export out of Geraldton, and mining in the Midwest, and potentially even outside of that, are all within the scope of activities. But we start with the most obvious, which is extending the life of Iron Ridge, expanding our existing iron ore production, and then looking for other revenue and other profit operations. But we are very motivated on building a larger company based on the cash that we're generating.
Mm-hmm. Yeah, it's such a unique position that you're in. Looking forward, what can investors expect in terms of upcoming news flow? Will there be any drilling results or anything from Iron Ridge that you can give us a preview of?
I think Fenix can expect, shareholders of Fenix can expect, and hopefully some interested observers, and if you are looking, you can expect that we'll maintain the discipline and the focus on hitting our operational milestones, keeping the continuity of our existing and the quality of our iron ore, and maintaining our cost focus, and enjoying higher spot prices and generating as much profit as we can in the second half. And then when we can execute on growth transactions, we'll be reporting to the market, and we're looking for them. We've said that for a while. Those things we're just the discipline we have in our business in controlling costs and keeping operations running. We also have in looking at new growth opportunities, and so they require evaluation, and we're working with a number of different opportunities, and whenever they get to a material point, we'll announce them, and they include joint venture opportunities as well as potential acquisitions.
Mm-hmm. And final question on the dividend, I know that you've addressed this in previous webinars and in the announcement, but regarding an interim dividend, what can you just fill us in again on why you're not doing that?
Look, we do have a strong balance sheet. The the half-year accounts show the volatility in our business. If you stripped out, I just mentioned, in the absence of the Fenix Newhall transaction, the numbers would have been very different. In the absence of our ongoing ability and strategy around hedging, the numbers would have been different. And so it is prudent and conservative to announce a dividend, as healthy and as strong a dividend as we can. And to do that, we'd like to wait until we know the final position of the accounts and the iron ore prices that are prevailing all the way through to the end of the year. And that's consistent. We've never made a decision to pay an interim dividend, and given the current scale and nature and volatility in our business, it would be unlikely that we do so, pending very strong iron ore prices and certainty of iron ore prices. So we've communicated that consistently. We're looking forward to being in a strong position to pay a full year dividend.
Perfect, thank you. So any of the questions that were more technical and accounting based that was sent through, as John mentioned previously, we will get back to you individually via email. Thank you for your time. John, is there any final parting comments that you want to leave investors with?
Just a congratulations to the team again for the work we did during what was a period of largely falling iron ore prices and cost inflation, and to maintain and actually reduce our C1 cash costs, integrate the Fenix Newhall business, and maintain our operations was a strong focus. And now we need to continue that in what is a much better price environment. So looking forward to building cash during the second half, and also continuing to look for new opportunities for Fenix. So I agree with you, Dannika, it's a very exciting company, and have been really appreciative of the inquiry and comments from shareholders. We'll try and respond to every question. So our email contact details are on the website or through Dannika and her team. Very happy to respond to any further questions, technical or simple in nature, outside of the webinar as well as in it. So thanks very much for your interest today.
Absolutely. Thank you, John. We'll see you soon.
Thanks, everyone. Bye.